a lot of stocks, know which stock to invest on. Okay, so Yahoo Finance is one of those companies you can derive a lot of information about the stock price, and you can see some of the graphs and use those graphs to see where the company is actually going in terms of value. And then from there you should be able to know if you are going to invest in this company or not. So we look at how data analytics are affecting what auditors do. So modern data analytics are changing in the world of auditing today. You can see in those days, everybody fold their sleeves and it was all manual. But this time, everything is almost computerized. So now they look at those areas based on, they can even, without even visiting the company, they can retrieve most of this information from the system themselves and analyze without even visiting the company itself. So financial analysis, information service have become the primary tools for professional analysts who use them to analyze competing firms. Even in this course also, you will see that we have started discussing ratios. Financial analysts, that is what they do. They extract this information, compute them in form of ratio, and use it to analyze the company performance. Looking at the company income, they are able to analyze and see if the company is very, very profitable, or return of assets for the shareholders. Shareholders are after the returns. We want to see the return of the investment. Okay, somebody came in. All right. Any questions so far? If there's no question. Okay, institutional and private investors, creditors, and others. So we also, in the financial system, we have those big investors also have very vested interest in whatever information is passed to the financial market. Some of them are lenders, creditors, and private investors, institutional, and you and I also, we may need the financial information for either for investment or to get a job. These days, I know people who look for a job, they don't go into checking a financial statement. But what if you jump into a company that is unable to pay your salary? I don't think you want to stay much with that company. Okay, let's now look at steps in accounting communication process, including issuance of press releases, annual report, quarterly reports, SEC filings, as well as role of online information services in this process. So steps in doing that, and when we look at it, we now look at, there are so many reports, annual report. So identifying the step in accounting communication process, including the issuance of process releases, annual report. Annual report, you will see that you will hear of Form 10K. Form 10K is what the company used to publish the annual report to SEC. And then we have also the quarterly report and so forth. They also, in some companies, most companies publish their quarterly report as well. So we have a disclosure process. Disclosure, the company, there is no limit as to disclosure. And for fair disclosure, require that company provide all investors equal access to all available information. You must give the investors information for them to act upon. If you give them misleading information, and they act on it, that would be a crime in the system. That would be a crime against the company. So managers and other insiders are prohibited from trading their company share based on non-public information. So we have public information. That is the information they're giving out to everybody, to investors. They give those information out to investors so that the investors can analyze the company and see if they will be able to act on it, if they will invest in the company. So that is what they do. But there may be other information, very, very sensitive information. If the company is not ready to issue such information, then they will keep that information in the system. They will not issue such information. I will give like example information about maybe the company is moving to another country, big expansion. That will make the information about the company to be very, very robust, and that should be able to increase the share value in the future. So that information probably is still in the process, still internal. So they cannot, they don't supposed to release such information. Such information is not to be released to the public until management deem it necessary to release and make that information accessible to everybody. In that case, everybody can act on it. So even employee cannot say, oh, okay, our company is expanding. There's a lot of positive information coming into the company. So that means the share price of this company, probably, for example, if the share price is $5 per share, probably by the time this information gets into the market, the share price will move from $5 to say $15. But because it is internal information, the employee cannot release such information unofficially, and they cannot act on that information and start buying shares of their company. So, let's go and buy these shares because of social information. If they act on it, that would be a crime. That would be a crime against them. So they don't act on it. Okay. So that is about it. Yes.
Can you give an example for like how this trading information happened?
Ask a question again. I don't hear you clearly. You are not very clear.
Can you give an example for how this information trading is happening?
About is it the public information or the private information in the system? Which one are you asking about?
No, I'm asking, can you give an example for how this internal information trading is happening?
Okay, the internal information we are talking about, most of this information may come out. For example, let us look at the financial statement of the company. As the financial statement is ending, supposing this is June, let us say June 30th is the end of financial year of ABC company. And ABC company for this financial year ending June 30th, they have made substantial profit, revenue. They have made a lot of money. Maybe last year, comparing last year to this year, June 2021 to June 2022, June 2022, they made $100 million profit, net profit. And June 2022, they made 250, more than double the profit, more than double that profit. If that information goes out, what will be the position of the company? I will ask that question back to you.
I think there will there will be more demand for this company shares, stocks.
And then what will happen to the shares? Yes,
it
you
will
are right.
price will increase.
The price will increase. That is a big news that is coming into the stock market. And this information, as of today, is still private, is internal to the company. Nobody can release such information unofficially. Nobody can act on it. The staff cannot go and buy shares based on that information they got. They know that the company has tripled their profit. So that information has to stay in the system until such a time that the income information is going to be disseminated. That is, the information is going to be released to the stock market. And I've told you the procedure. They will put they will complete that Form 10K. Form 10K is annual report for each company. They pass it because their financial statement has been audited by external auditors. They now pass it over to SEC. SEC will now release such information into the market, and that information become public. When the information become public, now you are giving all the players equal level of operation. You put them on equal platform. So now they can now act on that information. Everybody can now act. You will see that a lot of people will now run for their shares. And if possible, that may lead to scarcity of those shares. And when there's a scarcity of the shares, what happens? The price will go up. And the share price may be, for example, probably the share price is $15. You will see that with such a huge positive impact, the share price may go up to $20, $30, $40, $50. But if some people have acted on information that was not released to the market privately, those people will profit. We will profit in the system, profit in the market, and it is criminal. Such information, if you act on such information that is private and you are privy to that information because you are in the system or you are the accounting manager, then it may lead you to jail. And the other way around too, if you look at it, if there is unfavorable information coming into the system, unfavorable information coming is going to come out, definitely that will adversely affect the stock market. And then if you are privy to such information, you will now upload, so this company is going down. So what do I do with my shares? I have 1 million shares. What do? You go to the market, you want to upload the shares, sell the shares out. So, and the system, they have a way of checking. And I know of, which I don't want to mention, a lady that went to jail because when she realized that the company profitability was seriously affected, she was one of those top stockholders who owns a lot of shares in that company. So what did she do? She uploads some of those shares out. She sells some of those shares, and she went to jail. She went to jail for 5 years or more. Can't remember the number of years, but she went to jail. So you don't act on, if you are privy to information about the system, you don't act on it. Any question? Any other question? Any question? No question. Okay, right, we move. Okay, so we have what we call the press release excerpt. This is for Apple. The press release is written public news announcement, normally distributed to major news services. So some of the good news that is coming about the company may come in form of press release. Apple CEO, for example, will just go, either go visit one of the news organization and say, this is what I want to release about Apple, and then release those press release. So this excerpt is followed by management discussion of the results of they have obtained. So, okay, this is our result for this year. This is what we have done. And also it will include what we call very brief summary of the income statement and balance sheet. which will be included in the formal report to shareholders distributed after the press release. So usually it's after the press release, then the major information will now be released. Okay, I mentioned, if you recall now, I mentioned 10K. This is one of the disclosure process, annual reports and Form 10K. The annual report for privately held companies are simple documents including 4 basic financial statements, which you all know now. And I say, in addition to those 4 financial statements, we have what we call the release notes, the related notes, the footnotes. And the footnotes really capture so many things that are not in the financial statement. And in most cases, like depreciation, if they have changed depreciation, all will appear on the footnotes. And then you have what we call the report of independent accountants. That is their audit opinion. Like I said, they may be qualified and unqualified report. Qualified and unqualified report. That would be the audit opinion. If those statements they have audited, everything is in conformity with that, then there will be that audit opinion. And from 10K, I want everybody this week, you go through from 10K, you will see that it's number from item 1 down to item 18 or so. So you now, each item capture a particular information. So for example, item 1 of that 10K form describe the business operation and strategy. Then if you look at item 7, you will see other item 1, 2, 3, you keep going in that order. But item 7 also is very important. Management discussion and analysis. Management discussion and analysis is item 7. So the view, that is the management view of the causes of success or failure. So they have to explain it at that point. Item 7 will tell them, and then they can relate it to the economy as well, world economy. If you look at most of the report, a lot of people attributed their last year report to the global epidemic that happened. And really, that was true. Because of global epidemic, so many people, so many companies underperformed. So another item on that financial statement, another is item 8. I'm trying to look, I have it here. Item number 8. Item 8 is financial statements and supplemental data. So 4 basic financial statements and related notes, report of management, and the audit report. I have also, if you look at item 1, I told you that this is for business strategy. And if you look at item 1A, by the time you check, you see that item 1A is the risk factors. Every company operates within the ambit of risk. So they will also list what risk they encounter. For example, a trading company, I will not be surprised, trading company that will talk about supply chain, that there was a bottleneck of supply chain. Because of that, their performance was hampered. So now we have item 1B, unresolved staff comments. If they asked, everybody have a box where the staff go there and secretly put in comment about the companies, about the operation, whatever they do. And auditors open such boxes when they are auditing the account. Anyone that is unresolved is also going to appear on item 1B of that 10K. Then we have item number 2, properties of the company, what they own. All their properties, headquarters, branches, all will appear on item number 2. And then you have item number 3, legal proceedings. Or everything about legal, whether the company has been sued or the company sued, other people will always appear on item 3. So the most important items, like I said, is item number 7, management discussion and analysis, very important. Item number 8, financial statement. We all know all those financial statements by now. So all those items are very, very important. And by the time you go through it, you will see item number 10 and 11. 10 will have to do with director and executive officers of the company. And then the shares they own, their level of shares, all will be listed there. So from 10K, annual report is very, very comprehensive. Very, very comprehensive. Then item number 11 of that from 10K has to do with, item 11 have to do with executive compensation. They have to publish what the executive are earning, how much is CEO earning. The vice president, the vice president, what is he earning? The chief financial officer, what all will appear on item 11. So as an example, I homework, I want everybody go and get the under Edgar and get from 10K. Even if you go to Apple itself, you can see their own forms. You can see their form 10K if you go through the investors relations tab. You will see that form 10K. You will see all the items are standardized, listed. So I want you to go through it and write a short report on what appear on Form 10K. What appear on Form 10K. Item 1 up to item 15. So we take let's take a 10-minute break and come back after. Here my time will be 10 minutes, 5, 10 minutes break, and we come back after that time. 10-minute break, everyone.
Yes, sir.
Okay, Professor. Okay, thank you.
Okay, I'm in class. Hello?
Hello, sir.
Okay, I
Yes,
hope we're back.
Professor.
Okay, thank you. Okay, we did that. Like I said, also there's quarterly report. And then for quarterly report, you see 10K is annual report. You have to know the distinction between 10K reports, that is annual report, and then we have what we call 10Q for the quarterly report. And then we also have 8K. 8K is for current or special events. If the company is having any current events, you can always report it on 8K. So everything is so structurally organized. Everything is so structurally organized. So you should take note of the difference between 10K, 10Q, and 8K. Like I said, I want everybody to pick 10K and look at items from what you have on item 1 up to item 15, and write a very brief report or summary and send it to module. Okay, so also environmental, social, and governance reporting. So they also cover the annual report is very, very broad. So it's not only limited to financial statement. There is a notes, management discussion and analysis, and also report on the environment is also included. Recognizing and apply the different financial statements and disclosure format used by company in practice, and analyze the gross profit percentage. If you recall, we did net profit margin. Also, there's what we call gross profit percentage. Who can tell us what gross profit percentage is, even without us going into that part of it? Who can tell us what gross profit percentage is? Anybody there who can volunteer? Anybody can volunteer what gross profit percentage is?
Is it the net income over the revenues?
Okay. Net income all over revenue, is that not net profit margin? Is that net profit margin? Eh? Net income all over revenue, is that net profit margin? Okay, let's look at it this way. Income statement start from sales, and if you recall, I think we had a problem like that. So in our last quiz, sales, and then the next item is cost of goods sold. And if you subtract cost of goods sold from sales, what we have is gross profit. And then if we now remove expenses, administrative expenses, then we have what we call income before tax and extraordinary items. So now if you look at the first stage, sales less cost of goods sold, you get gross profit. Then what is gross profit percentage? I've provided the answer. Sales less cost of goods sold, you have gross profit. And if you recall, if we subtract expenses, we have income tax before tax and extraordinary items. And then if we add or subtract extraordinary items like interest expense or interest income, and then we take the tax, then we arrive at net income. And then we are able to know what net income percentage or net income margin is. But I'm asking now, what is gross profit margin? Nobody knows. Anybody can attempt. Anybody can attempt. Judea?
Professor, I think that...
No, I'm asking Judeline. Let Judeline attempt it. Okay. All right. Whoever wants to attempt can attempt. Yes. What do you say? The last person who will talk. The last person who will talk.
Yes, Professor. We can calculate gross profit margin by subtracting cost of goods sold from the net sales, the sales revenue.
No, yeah, I subtract cost of goods sold from revenue. What I arrive at is gross profit. If you divide gross profit by sales, you get what we call gross profit margin. And then if you multiply by 100, that would be gross profit percentage. So without even going into the note itself, going to the lecture, we should be able to have a good idea of what it is by looking at
Professor.
Yes.
Gross profit is equal to the income brought before taxes, right?
No, I said it. Gross profit.
Can you repeat again, please?
Okay, let me repeat. You recall income statement, right? You remember income statement we did, right? Everybody. So income statement, the first item there is sales. The first item on income statement is sales. And then we have what we call cost of goods sold. That is a big expense item of a company, any given company. Cost of goods sold. For manufacturing, for example, what is the composition of cost of goods sold for manufacturing? Raw material is one of it. Raw materials, and semi product. That is some form of input, labor, overhead, factory overhead have been added to that raw material. And then we have finished goods. So when you put all this together, we call it cost of goods sold. The raw material, semi-products, and the overhead expenses put together, we call that is cost of goods sold. And that is the first expense you subtract from income statement or from sales. So if you subtract that from sales, what you get a result is what we call gross profit. That is the first level of income. The first level of income, sales.
Professor, your voice was breaking. Can you repeat again the last part?
Okay, I said the first level of income is sales minus cost of goods sold. And the first level will be gross profit, what we call gross profit.
Professor, only cost of goods sold or other expenses as well?
Yes.
Only cost of goods sold or other expenses as well?
No, other expenses don't come first. First of all, when you put down sales, supposing let's use an analytical. Let's look at an example. For ABC company, sales is $50,000. They bought raw materials, they put in some labor, they have overhead, put those two together and give us what we call cost of goods sold. Supposing cost of goods sold in this case is 30,000. Cost of goods sold 30,000. So when you now subtract 30,000 from 50,000, what is left is 20,000. 20,000 is what we call gross profit. Did that make myself clear? Gross profit, sales less cost of
Professor,
goods. Yeah.
Professor, in the book, and it says pre-tax income.
Pre-tax income. We have,
So
is the first stage of this thing. We may not really call it pre-tax income, because when you get gross profit, the next thing is for you to subtract administrative expenses, salary, rent, stationery, all those. When you subtract that out, supposing that expenses, assuming the expenses is the total expenses so far, all these things I've listed, including depreciation expense, that is 8,000. So when you subtract this, then we arrive at 12,000. 12,000 is net income before tax and before extraordinary items. What are the extraordinary items?
So you mean the gross profit is purely the sales minus the expenses related to the sales, right?
No, you don't put it like that. It's the sales minus the cost of producing the product, not the sales. The sales expense will come under expenses after gross profit. Sales expense will come after the gross profit. The cost of goods sold is only talking about raw materials, and whatever inputs have been put into raw materials and the factory overhead expenses put together is what we call cost of goods sold. Cost of goods sold is a big expense item, quite different from administrative expense. Did I make myself clear?
Yes.
So in that case,
so there are levels of expenses.
Not level, level of income. Level of income. The first level of income is gross profit. The second level will be income before tax, before extraordinary items. Okay,
before tax and what?
Huh?
Before tax and what?
Before tax and before extraordinary items. And then when we talk about
like what? This like what? Can you give example for this extra?
Okay, let's go with my example. Okay, extraordinary item. What are we talking about? Okay, first of all, before we talk about that, you remember last week we talked about interest expense, right? We also talk about interest income, right? You see, when we get to this income after the expense, we have income before tax, before interest, before interest, and before tax, and also extraordinary item. If you recall, also we talk about gain or sales of fixed assets. If you sell fixed assets, and more than the book value. Did I make myself? Am I using a different language here? If you sell fixed assets, if you sell fixed asset above the book value. Suppose the book value of, say, company's factory machine, the book value is 200, and you sell it for 250. That make us, we have made a gain on that asset $50. So that will appear on income statement as gain, and that will be plus 50. But if it is 200 and you sell it for 180. You sell it for 180. That is below the book value. That will be minus 20. So in that case,
would be a loss.
Appear, huh?
That would be a loss.
That would be a loss. That would be a loss as far as that particular asset is concerned. So that would be minus 20. So now interest expense is always a negative. That is the price you pay for, the price the company pay for taking a loan. The price, let's put it that way, the price. So in that case, if it is $10, that would be minus $10. And then interest income is short-term investment or loan given to another company or loan given to staff. So in that case, if interest income is $8, that would be plus 8. So you can see all this adjustment would be done. After that, we will arrive at income. We now arrive at pre-tax income. Pre-tax income or income before tax. Did I make myself clear? So you can see we have gross profit. We have the next one, profit before interest and extraordinary items. So after that, we have gain or sale of fixed asset. Then we arrive at what we call the pre-tax income. Why do we call it pre-tax? Because after that, the next step is for us to calculate the tax.
I think, Professor, that the confusion happened from the word profit and income. Because what's mentioned, the word itself, this is the confusion came from. You used profit when in all the examples we have seen, it's mentioned as income.
Well, income and profit at times they are interchangeable, but you should understand what we have just done now. I've been able to run you through income statement, right?
Yes.
So income and profit are interchangeable. Okay, look at the first level of income. We call it gross profit. Gross profit. The first level of income. We call it gross profit. So income and profit is always interchangeable. But what I want to drive home here is that you should understand the line of calculations, the line of where you put what. Where do you put cost of goods sold? When you put cost of goods sold and deduct, what is the result of that? That is the first level. And then when you subtract expenses, what do you arrive at? The second level. When you subtract interest, add income, and then adjust extraordinary item, what do you arrive at? Pre-tax income. If you call it pre-tax profit, I will give you 100%. If you call it pre-tax income, I will give you 100%. Because with that analysis, I know you know what you are talking about. So pre-tax income, that is where you arrive at pre-tax income. I don't want you to subtract cost of goods sold and say that is pre-tax income. That's why I say it may not. I may not call it pre-tax income because I have not reached the level where income tax should be calculated and deducted from the income. And you can see the moment you deduct the tax, then you arrive at the last level, that is net income. And you can also call it net profit. So what is wrong with net profit, net income? Same thing. It's interchangeable. So I hope I make myself very clear there.
Yes, Professor.
Any other question? No. Okay. Okay. Let's closer look at financial statement format and notes. I know we have done financial statement. We have done the first thing the first information or the first thing we did was to look at what do we call consolidated. So now we can look at comparative financial statement. What do we call comparative financial statement? So the comparative means that in most cases, 3-year financial statement is being given to us as investors, as market players, analysts. So based on that, you should be able to have, that is what we call comparative financial statement. 2000, for example, I'll give you 2019, 2020, 2021. So if you have 3-year financial statement, that's what we call comparative. And then we have other classification. In most cases, when we look at income statement, if you remember, we have to classify what is the actual profit that the company has made or income, and then we do the classification down the line to the tax. And also classification of assets and the subtotal. And then you have also the notes, additional disclosure that is necessary for you to understand the financial statement. You recall we look at balance sheet already, starting from liquid assets all down the line, from current asset, fixed assets, and then liabilities. Okay. Classified income statement. Manufacturing and merchandising company that sells goods report the subtotal gross profit. So we have come now to that gross profit. So in this case, I think we'll be flying past it because we have already dwelled heavily on what we call gross profit. Gross profit, also called gross margin, is the difference between the net sales and the cost of goods sold. So you see where we are now. So we have even jumped to this point already. So we have the gross profit margin, the difference between the two, between the sales and the cost of goods sold. And take note, I always like to explain everything in detail. See, we are not talking about sales. We are talking about net sales. Why do we say net sales? We'll have an idea. You have the textbook, so you have to be reading most of this textbook and then come so that we just discuss. So what do we call net sales? Or why can't we say sales instead of net sales? Who have an idea? Why do we say net sales and not sales? Okay, I put it the other way around. I know somebody will help me now. What is it? There is difference between net sales and gross sales. You can tell us the difference between net sales and gross sales.
I think the expenses, the expenses, the cost.
The expenses?
Yeah.
Okay, we may not see all that, but being in this class, you should really know every numbers, every theory behind the numbers. In most cases, what you see, you always see net sales, but the company has adjusted that sales figure. It's always gross when they sell to customer. The ledger, there's a ledger we call gross sales. There's a ledger we call gross sales. There's
So
another.
This is the price of the sales itself.
Yeah?
This is the price of the sales itself. The face is a face price.
that is the actual thing we sell. Supposing you are buying, let's say, an example of any product. Supposing you are buying, let's say, a car. All of us like driving cars. So supposing you want to buy a car, and the car is costing 50,000 gross. This is 50,000 gross. 50,000, that is the cost of the car. And I told you there's another ledger we call discounts. Discounts. There's another ledger still connecting to sales we call returns. For discounts, supposing the car is costing 50, it's okay. The company may do promotions. Okay, if you buy the car today, we'll give you 10% discount. 10% discount will hit the discount ledger. 10% of 50,000 is $5,000. 5,000. Okay, so now the final, yes?
Yes, 5,000.
5,000 will be the discount because the company is giving 10% as promotion, right? So that will be on discount. The will be on discount ledger. Okay, but supposing also the company was able to sell 3 cars that day. So these 3 cars will be $150. Am I right? The company will sell 3 cars, 150, and the
but
discount.
There's a discount.
The discount will be 5,000.
So 15,000.
So 15,000 will be the
so
total.
135,000 sales.
Very good. So what will it be? That 135,000 will be what? Will be net sales. Will be net sales. You see how net sales come about in the published account? As soon as they look at the gross sales, they now take the discount. If there was a discount given, you subtract the discount given, what you arrive at is net sales. But something else is there. Supposing the 150 car was purchased, but 2 days later, one of the customers said, no, I think I don't like this car, I'm returning it. So he returned the car. That will hit, returns is 50,000. So return 50,000. You see what I'm talking about? So now, if I say gross sale 150,000 minus discount 15,000, minus discount 15,000, and then minus 50,000. So that means the net sales figure has changed.
So in this case, net sales is the gross sales minus discounts minus returns.
Very good. Gross sales less discount less returns is equal to net sales. So that is why you can see, you see in the textbook, you see they say net sales. That means there are so many numbers behind the net sales, so many ledgers that come in before the net sales. Before you now arrive at net sales, that is where cost of goods sold will be now subtracted from it. Cost of goods sold will now be subtracted. So now we have the difference. Now we look at what we call the operating income. The operating income. Now the first level of, what is the first level of profit?
Gross profit.
Gross profit. So now, very good. So now we move to the next level. The next level now we subtract operating expenses. All expenses related to profit, income, we subtract. When we subtract it from the gross profit. We arrive at what we call operating income. We arrive at what we call, operating income. operating profit, or profit before interest and tax and extraordinary items.
Or income before tax.
Income, huh?
Or income before tax.
Huh?
Is this equals to income before tax also?
Which one?
The profit before tax.
You have to follow the items that are on income statement. Before I arrive at pre-tax income or income before tax, I must have subtracted or added interest expense or interest income, and also I must have added or subtracted extraordinary items. Then I arrive at I arrive at net income before tax. Anything before tax, we must have done all the adjustments. All the adjustment has been done. So what we arrive at now is net income before tax. And so many companies, they call it different name. Pre-tax income is still okay. Pre-tax profit is still okay. And then when we now make provision, okay, you see provision for income tax. When you make provision for income tax is an expense. Where is that money going to? For income tax, where is it going to?
The government. Income tax is the government. The government.
Yeah, very good, very good. The government. Occasionally I will ask those questions, those obvious questions. So that income tax is going to go to the government, and you know that it will impact on the cash flow of the company, because the company is going to pay money out to the government. So it will impact on them. They have to make provision for income tax. Then we arrive at the last level of income. That is net income. Net income has taken care of everything. It has taken care of cost of goods sold. He has taken care of the operating expenses. He has taken care of interest income, interest expense, extraordinary item. He has taken care of the tax. Then we arrive at net income. And that is why in most cases you hear companies saying bottom line. That is the bottom line. That is the bottom line, which is always being protected, because a lot of analysis will hover around net income. Like return on assets will be vested on net income and so forth. Any question? No question?
No, Professor.
Okay, so you can see income statement for Apple there. If you look at Apple, you see the income statement. And you can see their they have already arrived at net sales. A lot of work behind it. If you look at it, they have arrived at net sales. Have you everybody seen Apple income statement there on the screen? Everybody see income statement of Apple on the screen?
Yes, sir.
Okay. So you can see they are starting from net sales. But is that the first stage based on what we have just discovered? That is not the first stage. They normally start from gross profit, gross sales. Sorry, they start from gross sales, but in this case, they have already done that already. So what they are coming up with is net sales. Net sales. And if you look at Apple, what did Apple sell? What did they sell?
Mobiles, laptops.
What do you call mobile? Is it product or services?
Product.
Product, yeah. And they also sell what we call they also have, you can see net sales, that net sales has products, right? Yes. Product carry the bulk of their net sales. And then they have a very small amount there, but relatively anyway, to products, services. what do you think are Apple's services they are selling? What do you think are the
Mobile
Apple's
fixing, for example? Mobile
Huh?
fixing? Mobile fixing?
Mobile fixing. That is repairs, right?
Repairs, yes, sorry.
Yeah, okay. Repairs, maybe. Repairs may not be it. Somebody come up with, because repairs is an expense to them. Yeah, we see now, we see Apple have products, sales product. The sales here is 220,747 000 meters. But they also report services.
Oh, sir.
Huh?
Sir, can I ask a question?
No, I'm asking a question. I want the answer first before you ask your own question. The service that appear on income statement for Apple, what do we call those services? Before you ask your question, can you answer my question first? Huh? There's no penalty for guesswork. If you guess and you don't get it, we get it corrected and we continue to move on. So there is no penalty for guesswork. So what will it be? What is your idea about Apple? We are not working on only textbook. We want to work on a very broad knowledge of whatever we are doing. Okay. Do we know something about?
Can technical services be one of the services?
One of what? Say it again.
Technical service. Technical support, I meant support.
Technical support, they give it in a way for free, but they have the services I was talking about is when you buy Apple, they will ask you,
Okay.
do you want
Books, Apple Books, Apple Music. Those can be services, right?
Yeah, Apple Music is one of it. That is one of the bulk of what they have. That is not product. Is that a product? It's not. Apple Music. It's one of it.
Yes. Apple
Then
Books
in
too.
addition,
Books.
I'll add something to you there. In addition to that, too, when you go to Apple Store to buy their phone, they will ask you, do you need a 2-year warranty? 2-year warranty. It will fall under services. Then you say, okay, yeah, okay, 2 years. We can give you 4 years. You say, okay, what is 2 years? They say 2 years will cost you additional $100. Additional $100. Yeah. Huh?
Yes.
It will cost you additional $100. So that will fall under services. So you can see now they will have total sales now. And then in this case, because this is not a manufacturing, their emphasis is when they produce the product, they do the sales. So now they look at cost of sales. The product has been produced. So how much is iPhone 13? Maybe $1,000. $1,000. And then they will look at the cost of it. They are selling it to you 1,000, but probably to produce it, it costs them maybe $600 to produce it. So that will appear under cost of sales. Then you can see again it's split into product and services. Somebody mentioned technical repairs and technical support. That will appear, that will be an expense to them, because if you are if your system breakdown, yeah, they will fix it. They want to fix it for you so that you continue to use their product. So all that moved down to what we call, you can see now, the next thing, when we subtract all the costs, we have what we call the gross margin. We call it gross margin because it's relative to sales. Gross margin relative to sales. And then from there, we now start taking administrative expense, that is operating expenses out of the gross profit margin or gross margin. And then everything take us down to net income. And then we have earnings per share. I think I had that in the problem last time. I said earning per share. I gave you calculation. How do you get earning per share for this apple? Who knows? Not necessarily for apple. How do you calculate earning per share? Who knows?
You divide
Uh,
the net income
Mhm.
with the average number of shares.
Very good. By the total average number of shares. Very good. That's how we get that number there. Okay. Is there? Okay. Net income, weighted average number of shares of common stock outstanding at that date. So now also, we have what we call preferred stock dividend. You subtract that out because that definitely you must take it out of net income. What is available is for the shareholders. That is why we want to divide what is available by the common stock outstanding. So for the comprehensive statement, both FSAB and International Accounting Standard Board, they require an additional statement. There are a lot of things. That is why a lot of companies would prefer to go private than to go public, because there are a lot of things that is needed for them to report. So the short form of net income, they also want to analyze and know the input, foreign currency transaction input, change in unrealized gain or loss on the derivative instruments, and change in unrealized gain or loss on marketable debt security. All that will make an adjustment to the net income reported by Apple. Okay, we have talked about gross profit margin already. Now you know this is it. I always project when I see those numbers, figures. When I look at some of those statements, I have to now some of the things we are going to encounter in future, so that by the time it gets here, and I hope everybody are conversant with how this ratio is calculated. Is there any question before we move on? Any question before we move on?
No, Professor.
Or if you don't have
No, Professor.
question, okay. So you can see we have done a lot of work here already. And you can see it's for 3 years. For 3 years. 2018, 19, 20. Unfortunately, we don't have 21 yet. Okay. So if you now compare the numbers, this thing, you see if Apple is performing better or not.
Well, there, based if you return the slide,
Yeah.
Well,
Right.
here, like 2018 is 38%. Then reduced, the gross profit percentage became less in 2019. And even in 2020, it didn't reach what was in 2018.
In 2018 it was 38.3.
38.3. In 2019, 37.8. So this is reduced.
But that means you can see, okay, approximately, okay, let's look at it this way. In 2018, let's say it was 38%. In 2019, it was 38% as well, right? I
No,
don't say what I see.
37.8.
No, I see it as 38%.
That's 38. That's in 2018.
That 2019 is 37.8. If
So
you take
that's
it to one
less
place
by
of
0.5.
huh?
That is less than 2018 by 0.5.
Okay. Let's approximate. What is the approximate figure for 38.3? 38.3 will throw away that 3%, that 0.3, and take 38 approximately. Correct?
No, again,
We are
please.
I want us to stay with just the whole numbers. So 0.3.
In this case, both the same are both. All the 3 years are the same.
Are they the same?
If we will follow just one single
Don't
digit,
follow what I'm saying.
fraction.
Mathematically, you are mathematically, you are right. Approximately 2018, it was 38%. Approximately 2019, it was 38%. Approximately 2020 was 38%. Do you see consistency in their gross profit percentage? Huh?
Yes.
That is where you see performance of a company. So that means what is attributing to this? That means their cost of goods sold is steady. They have controlled that part of the expenses, which is a huge expenses. They have been able to control it, and they don't allow it to change over time. That is why you can see consistently they have reported 38%. I will not, as an analyst, I will look at these as the same numbers. I would not want to go into that. So there is nothing to look for here, because consistently 2018, 38%, 2019, 38%, 2020, 38%. So it's consistency. That is comparison. When we compare the 3 years, you see that it's a steady margin. Then, which other competitors do they have? They have a lot of competitors, but one of their closest rival is HP. Do you see gross profit margin of HP? What is it? 18%. That is a disaster. Compared to Apple, it's a disaster. 18%, while their closest competitor, Apple, is on 38%. So you can see then if you give me the shares based on this performance, only on gross percentage, there are other parameters to be considered. But based on this alone, I would say, yeah, this Apple is well managed compared to HP. I would not want to invest in HP based on what I'm seeing here. So you can see HP means there are a lot of cost of sales or cost of goods sold. A lot has drained their revenue. They have only 18% left. Huh?
Okay, I understand.
Okay, that's very good. So now we have been able to compare over time. We are also comparing with the competitors. And then the third thing as an analyst, when you compare over time, year to year, You also compare with competitors. Then you compare with industry. Industry. For the industry where Apple operates, we have to look at industry average for gross profit for us to say yes, Apple has performed above in the industry or below. So the industry information we don't have, but if you also take that as a challenge and look at their performance compared to the industry standard and see if they are both industry or not. So that when we come next week, you will be able to discuss a little bit of Apple before we go into something else. A little bit of Apple, because I want you to take that. So I've given you two assignments, and they are going to be graded assignment, mind you. That is the way I give my assignment in most cases. So you have the 10K, look through it, get it, and give me the brief summary of everything there. I want you to understand what appear on 10K. And also, I want you to look at Apple gross profit percentage, compare it to the industry, and give me a brief statement as to their performance. You can add two other competitors. There are other competitors. You can use HP. In addition to HP, you can include a company like Dell. Dell is Dell. They also are in the same industry. So if you look at those three, you look at Dell, you look at HP, and then see if there are changes. Okay, let's take a 15-minute break. When we come back, yeah, go ahead.
Where we can find the information related to Dell again?
You mean Dell?
Yes, the information related to them, where we can find it.
Okay, this is where you are in this course, and secondly, now we have discussed where you get information. Either you go to the stock exchange, or you go to Edgar, or you go to the company website itself.
Okay.
You see, you guys are blessed. When I did my first degree, for example, there was no computer. What do? Everything is manual. I want to get information about, let me give an example. I want to get information about Apple. Do you know what I do? I have to get myself down to Apple office, head office, and tell them, oh, please, I need this information. But now, in the comfort of your home, we are talking now. In the comfort of your home, you can get all this information. There are so many sources. So you can get Apple, you can get industry, their industry numbers. They publish their industry as well, in most cases. So I want you to do that analysis on the site, and then from 10K on the other side. So let's take 15-minute break and come back. Thank you.
Thank you.
I'm back. Okay, we just finished. We have been looking at gross profit, and I know that we will have other ratios like return on assets that measure the overall performance of the company. Return on asset is ROA. So we'll be looking at that as well later on. Then this stockholders' equity. We have talked about stockholders' equity before, so why we don't have much to report. And then statement of cash flows. So how do we prepare cash flow statement is based on the three activities of the company we talk about, the company activities. And the first activity is operating activities, then investing activities. That is how to prepare cash flow, investing activities. And then the third one is financing. So if we are to prepare cash flow, we are to look at operating activities, investing activities, and then financing. So we have to look at what happened in operating activities starting from the net income. If you start from the net income, you have to subtract item that does not involve movement of cash. You have to subtract that. Anything accrual, credit, we have to take it out and then adjust to have the net operating activities cash flow. And then investing, if we are buying assets, that would be a minus on investing activities. Minus will be negative impact to cash flow. And also, if we are selling, will be positive. And then financing activities as well. If the company take a loan, that will be plus that loan to cash flow. If they are repaying the loan, also it will be in negative numbers. So cash flow from operating, like I reported, we have the direct method and indirect method. And both will lead us to the same cash flow from operating activities. The indirect method is what I just mentioned. Start with the net income, then plus or minus adjustment for non-cash items. And for net income, one of the key non-cash items is something like depreciation. Depreciation will be added back when we are preparing cash flow from operating activity. Depreciation will be added because depreciation is a non-cash item. It's just a book entry. It does not involve movement of cash. But if you recall, when we are estimating net income, we have to subtract depreciation. So we subtract depreciation of assets, but then when we are preparing cash flow, we have to add it back because it's a non-cash items. So after doing that, what we arrive at will be cash provided by operating activities. You start with the net income in direct method, plus or minus adjustment. For direct method, you go straight and pick all the items that contributed positively to cash flow, and then you subtract items like payments, and then you arrive at the net cash flow. That is direct method. Both methods will lead us to the same conclusion. So if you look at, this is Apple cash flow statements. Here it starts from operating activities right down, investing activities, financing activities, and then you arrive at the net cash flow. So under each of those activities, I told you last time we discussed, we have three major activities, or companies' activities divided into three major: operating, investing, financing. And each of them involve plus or minus cash flow, inflow or outflow. So if you now add the net cash flow from operating activity to the net cash flow from investing activity to the net cash flow from financing activity, we arrive at the cash flow for the company. And then we add or subtract from the cash flow before that period. So the next thing we are looking at now, still about reporting standards. We look at the notes to financial statements. All financial report, including additional information in the note that follow the statement. There must be those notes, description of the key accounting rules, additional details supporting reported numbers, relevant financial information not disclosed on the statement. For example, if there's there are accounting changes, notes will be able to tell us what are those changes. For example, a company that was operating on a straight line depreciation is now moving to a different depreciation method. So this is the correct place where those things will be disclosed. Accounting rules apply in the company statement. So this is part of it. Like if you look at from 10K, you will see note 1, summary of significant accounting policies. How those policies, they may appear in the balance sheet, but the actual notes are not there in the balance sheet. This will help us understand what is in the 4 accounting statements. Additional details, second category of note provides supplemental information concerning the data shown in the financial statement. For example, we have this land. They will now split the land and buildings, machinery. So at times it is grouped as fixed assets, but the note will be able to expatiate on what are the composition of the fixed assets in this case. Then we have contingent liabilities also. You will not see it on the accounting statement, but this is the appropriate place in which they will be mentioned. Contingent liabilities. Any questions so far? Any question? Okay, so voluntary disclosure. For example, GAAP and SEC regulations set only the minimum level of required financial disclosure. Those are the minimum. So if a company want to go beyond the minimum, yes, they are free to do so. It will only help their own case. It will only help the companies to really portray what their financial statements are. It will elaborate and give them more explanation. Like for Apple, they have iPhone, and then these are the sales product for 2021, 2022, 2019, and 18. You can see they have iPhone and Mac, iPad, whereabout home and accessories services. I will ask a question here. So which one is the core major source of revenue for Apple? Who can answer the question?
That would be the iPhone.
You see, it's iPhone.
Yeah.
So supposing now Apple stopped producing iPhone. Joel, I'm in the class now. Thank you. All right, I'll call you. Okay. All right. So supposing we get rid of, supposing Apple now say they are not going to produce iPhone. Will that be a good idea or not, and why?
Well, I don't have a problem. They stop producing iPhone. I'm using Samsung.
So you don't care.
Exactly.
Okay, you don't care. But what if you want to make money in the stock market?
Then I will sell Apple shares.
Yeah, very good. You will sell Apple share, because if you leave it the way it is, you say, oh, this company is gone. Their major source of revenue is gone. What are they doing? So you see, you also as an analyst and somebody who is going to be, as I say, you are going to be knowledgeable in accounting after finishing this course, or maybe go beyond and do other things like investment and so forth. You want to analyze this voluntary disclosure. It is not required for them to break it into this. What they need is total net sales. That is what SEC and GAAP mandated them to do. But look at them. They go beyond that and give you information. What is the net sales on iPhone, Mac, iPad, other accessory services. So how useful is this information to you as an investor? You can tell me what you will do with this information. You can tell me what you can do with this information. All information are there.
Can you repeat the question and the answer?
I said, what will you do with this voluntary information they just gave to us? They break down their net sales into iPhone, Mac, iPad, accessories, and services. So what are you going to do with this information?
Take a decision to invest or not.
Huh?
Take a decision to invest or not.
Okay, but then what you the first thing you will do, you want to analyze this information, right?
Yes.
That is why we're in this course. Any information given to us, we don't just look at it on the near, just look at it. If you look at it just casually, then there's not much difference between you and somebody who have not done this course, or somebody who have no knowledge of finance or accounting. But what you go beyond this is that, well, total sales 274. What percentage of total net sales is iPhone? Who can calculate that and tell us? I want one person to calculate iPhone total sales, another person for Mac, another person for iPad, another person for accessories, another person for services. 1, 2, 3, 4, 5. Who have gotten for iPhone? Who have gotten it for iPhone?
Professor, total sales of the 3 years for iPhone, for example?
Look at the 2020. 2020 is the latest financial statement. Let's look at that.
2020, okay.
Guys, I want to know, let me put it clearly, what I'm looking for, the contribution of each of these products, iPhone, Mac, accessory, services to Apple net sales. Contribution, that's what we call it, contribution. So
well,
iPhone
for
is
iPhone,
what?
it's contributing with 50% of the net sales.
Is it 50%, 50 point something, right?
50, yeah, 50.2.
50 point what?
0.19.
Plus 19%, okay. Okay, let me say 50.2. Let me cancel that. Okay, 50.2%. Who has gotten for Mark? Mark.
Yeah.
Mark.
Sorry,
Mark,
I was
10%.
talking to my daughter.
Mark is what?
10%.
10.42%.
10 point what?
10.42. 42.
42. Okay, let's call it 10.2%. Okay. Who has gotten for iPad? iPad.
Just a moment, Professor. I calculated Mac.
Huh? iPad. Who got for iPad? Who got for iPad?
It's 8.6%, Professor.
8.6%. 8.6%. Okay. Accessories. Accessories.
11.15. 11.15.
Huh? 11.15, right?
Yes.
So let's call it 11.2%. Okay, what of services?
Services 9.5.
Is 36 what?
Services 19.5.
19. Is it? Okay, 19.5. Let's add all of them now. 19.5. If you add all of them, what do you get?
19.58.
Huh?
19.58, exactly.
19.58. Okay, let's call it
You can round it to 19.9.
19.58 is 19.6, right?
Yes, 19.6.
Okay. Okay, now let's add everything and see what we get. 8.2 plus 10.4 plus 8.6 plus 11.2 plus 19.6. Okay, I got exactly 100%. So you can now see that the core of the business is iPhone, but then there is no product that they can get rid of here. If they get rid of iPhone, so they will have only 50%, 50% sales. If they get rid of all other items here, they will have only 50% of iPhone. I'm hearing some noise. So you can see that there is no way they can operate without any of these products missing or services missing from their collection. That is why they are putting it there. So they are well diversified. Apart from iPhone that controls 50% of their sales, apart from iPhone, every other items does not really have any controlling effect. Mac is 10.4, iPad is 8.6, accessory is 11%, services is 20%. So they don't have any controlling effect. If you get rid of services, they are still having 80% of the sales. If you get rid of accessory, they will still have almost 90% of the sales. If you get rid of iPad, they still have 92% of the sales. If you get rid of Mac, they still have 90%. So you can see, apart from iPhone, there is no product that you can say this is the controlling product. Only iPhone is their controlling product. So that is how you get the analysis done, and then you know what is driving Apple sales. What is the driver? The main driver is iPhone. I don't need anybody to tell me that.
Professor, this was the contribution for sales. So do we also calculate the contribution of every item for the net income? Because maybe the iPhone expenses were more than the iPad expenses. So the contribution iPad to net income would be more. Do we also consider that?
Well, you have even answered the question before. You remember the gross profit margin, right? Okay. What was that gross profit margin?
Sorry?
38%. 38%. So that is where the cost of sales coming, the cost of goods sold coming. 38%. 28%. So that means you can easily know the contribution of iPhone in terms of gross profit margin. So that is where it comes in. Okay. So analyze a company performance based on return on assets. You remember I've just quickly mentioned as a return on assets. Return on assets. We call it ROA, return on assets. Who are those interested? The stockholders, the owners of the business. They want to know the return on assets, if it is still viable for them to continue investing their money in Apple or in any other company. And it's always net income all over average total assets. Now let's explain that returns. We have seen average is being introduced. Why is the average being introduced? Why don't we say net income all over total assets? Yes? Yes? Why don't we say net income all over total assets? Anybody knows? Okay, anytime we are, as analysts, anytime we are calculating ratios, if the input is from the balance sheet, we always take the average. We will look at the beginning assets. That is, let's look at it this way. So we look at January. Supposing this company starts from January to December, if we want to use total asset, we look at total asset as at January. And if total asset as at January is, say, $8, I'm just giving an example. And as at December, this same total asset is $10. So for us to calculate return on asset, we have to add $8 plus $10 and divide that by 2. So if we do that, that will give us $18 divided by 2, which is equals to $9. So that means we will use the number 9. We will not use 8, we will not use 10. We will use the average. Anytime we are dealing with items from the balance sheet, we look at the average. Because the balance sheet is a snapshot. A snapshot as at the end of the year or as at the beginning of the year. So we always look at that. So beginning total asset plus ending total asset, that means divide by 2. Beginning, in this case, January. Supposing the company start in January and end in December. So beginning in January, you end in December. So in that case, we are looking at the asset, we are looking at January 2021 and December balance sheet 2022. We look at these two balance sheets and pick the total asset from there. Okay. So also, we can look at return on asset profit driver analysis. So in this case, we know that this is return on asset is net profit margin multiplied by total asset turnover. If you break this down, you'll see that what is net profit margin? Who know what net profit margin is? Or should I say net income so that I will not be confused? Net profit margin. So, well, if you break it down, which is over sales, which is net income all over sales, multiplied by net sales all over average total assets. That is total asset turnover is net sales all over average total assets. And then the net profit margin is net income all over sales. So with this, we should be able to know the driver of return on assets. If this net income over net sales changes, everything here will change. Net return on asset will also change. If it is down, if it is negative, it will impact on this too. It will impact on everything on return on assets. Any question? Any question on that? Okay, so we. Okay, how transaction affect ratios? Ratios are affected by transactions because ratio is based on the financial data we have. If you remember how I talk about ratio when we were looking at it, you must first of all, like when I was looking at, I said net sales, you look at the discount, you look at the return, you look at the returns, and then you arrive at net sales or gross sales, from gross sales to net sales. So also looking at ratio is affected by a number of issues. Like if you look at who can tell us the first ratio we did, the first ratio. I don't want to be the only one talking. What was the first ratio we did? The first ratio. Who can tell us the first ratio we did in this class?
The net profit.
Huh?
The net profit.
That was not the first ratio we did in the whole class. For the past weeks, there was a ratio we did very first time when we were dealing with balance sheets. When we're dealing with balance sheet, what do? Do we say current asset all over current liability? Do we say that? Current asset divided by current liability, that would give us what we call current ratio. That will give us what we call current ratio.
Which is the ability of the company to cover its assets, its liabilities. Yes, yes.
The ability to cover its liability. You don't stop from there. Is it short term or long term? Short term or long term?
Short term.
Yeah. So I want, when you are making a statement, make it very close statement so that nobody will start puncturing your statement. For example, yes, the ability of the company to meet their financial obligation short term. Because we can also measure long term, where we look at liability all over asset itself, long term. So we did current ratio, and then the transaction we are talking about here, current ratio, what is current asset, which is a denominator here. Current asset, we have cash, we have inventory, we have investment. So we have so many things. So supposing now we are paying a creditor, we are paying back a creditor $50. You will see that it will affect this transaction. It will affect the transaction because current asset has been reduced by $50 because cash is part of current asset. So those are the transactions. So first of all, you have to journalize that transaction. What was it? Was it a debit or credit? Was it a minus? If money was taken out, that is negative to the cash flow. So in that case, $50 was paid to the creditor. So we will credit cash $50. You see, we credit cash $50 because cash account is always in debit because it's an asset, and then we debit liability, short-term liability, which is the actual creditor we're going to pay off. At the end of it, as a T account, credit will always balance debit. 50-50. So you journalize it so that you know the actual effect and you know which account. In this case, we are crediting cash. So that means cash is reduced by $50. And then we are debiting this liability. That means that liability 2, we have paid off liability, we are reducing liability 2 by $50. If the company was owing $80 and is paying back 50, that means liability have reduced to 30. So it will affect the current ratio. That is what we are talking about here. So you can see what, like for example, what if only the numerator of denominator is affected? For example, Apple incur an additional 1,000 in research and development expense paid for in cash. Paid for in cash. So you can see that research and development is an expense. So if it is an expense, which statement will be affected? Who can answer that question? Which statement will be affected? Which statement will be affected?
Cash flow.
Huh?
I think the net
Cash flow.
profit margin.
You say?
I'm saying cash flow. Cash flow
It's not
statement.
income statement will be affected because it's an expense. Research and development is an expense. So we'll debit research and development 1,000, which is a direct negative expense to income statement, and we credit cash account. So those are the transactions that will be affected. So in that case, research and development income statement is affected. Cash is also affected. And the analysis you can see, net income is 57,411. We are subtracting 1,000 here because this was a negative impact. So they cannot report 57,000. They have spent additional 1,000 before the income statement was finalized. So now when you take that one off, it becomes 56. Then net sales here will also be, here it will be 57,451. It still remains the same because it has no effect on sales. It has effect on the net income. So if we are finding the net profit margin, it will be net income all of divided by net sales. So you can see that that ratio will reduce by 0. It will reduce by 0.004 from 0.209 to 0.205. So that is how the effects are. So you will look at other effects. There are so many of them. You will look at other effects itself, and then it will affect the ratio. It will affect also the relative accounts. Like for example 3, Apple paid 4,000 of account payable in cash. What is account payable? Is it an asset or liability account? Is it asset or liability account? Account payable. Who know what it is?
Account payable is liability, Professor.
Very good. What is the opposite of account payable in real sense?
Account receivable.
Very good. Account receivable is assets. Account receivable is asset. Account payable is liability. And if we are calculating current ratio, you know that will affect our ratio. Am I right? And for the mere fact that the company has reduced their liability, that ratio will definitely go up. The ratio of current ratio will definitely go up. But the effect is very clear in this case. You can see it will affect cash. Cash will be 141. So that means make the transaction current asset reduced by 4,000 because cash was paid out to 141,450. And because current liability was 105,392, the company will reduce its debt by 4. So that will now reduce it to 101,392. So you'll be thinking that, oh, because current assets have been reduced by 4,000, I expect current liability reducing by 4,000, that means the ratio will remain the same. No, you can see that the ratio changed from 1.38 to 1.40. So that means the ratio has improved. Which one is better, 1.40 or 1.38? Who can answer that question in analysis? If we're analyzing this, which one is better? Is it 1.38 or 1.48? 1.40.
1.44 is better.
It's better, yes. Because the company has reduced their debt. Because of that, their ratio has gone up. Even though the actual transaction was the same on both sides. It was the same on current asset, the same on current, but for the mere fact that they have paid off some liabilities, yes, the current ratio will, definitely the current ratio will go up. Okay, so that now brings us to the summary of how transaction affects ratio. So you can look through this summary and drive home what you have here. Is the same demonstration we have demonstrated on each of those ratios, how they affect. So before you journalize it and know their actual effect, and know is it current asset or current liability. If they are both sides affected, like for example, cash is paid, it will affect current asset. And because we use that to pay off liability, so it will affect liability side. So by the time you will get those ones adjusted and then rewrite the ratio, you will see that, or recalculate the ratio, you see that the ratio will be higher in that case, and vice versa. So depending on what the ratio is before that transaction, that is why you see here ratio if it is less than 1, if it is greater than 1. Ratio, current asset, for current ratio, it will always be, if it is 1, that means current asset is equal to current liability. So if it is less than 1, that means current liability is more than current asset. If it is greater than 1, then that means current asset is greater than current liabilities. So based on that, that is a summary of it. And then that takes us to the end of this chapter. We have explored all necessary for us to look at communications and those who are to benefit from those communications, from investors, creditors, employee management, regulators. All of them are all put together into the system that benefited from the financial statement. And we have also seen that the main document company used to publish their financial report or performance is 10K for annual, and then also 10Q for quarter reports, and then 8K for any special event. These 3 reports, I want you to take note of it. And then I gave you something on 10K, so you look at that. And then I gave you something on Apple. So you take note of that. Don't ask me, oh, what did you say about that? We have discussed everything. So I will need those reports to be prepared, those things we discussed, and I said it should be done. And then, very key, auditor's report. I told you what type of report are we looking at. The first report is unqualified. Unqualified, you should take note of that, unqualified report, and then qualified report. You should also take note of qualified report. And I told you it's opposite of what the way we perceive qualification to be. If you say I'm qualified to teach this course, that means I have the background, I have the degree to teach the course. But if I said, but in audit, when you say unqualified, that means that is the perfect report. That we should also take note of that. And then take note of how those ratios we have looked at. We keep progressing and adding ratio every time we are having a meeting, starting from current ratio, net profit margin, and now return on assets. So take note of all those ratios. Okay. All right, so that is the end of the class today. We see again next week, and if there is anything, you always check model in most cases in case I updated any information or assignment. All right, thank you.
Professor?
Yes, ask
Excuse
question
me.
before we go.
Yes, so I have a question about the quiz we had. So number 13, which said, which of the following statements is a GAAP?
Question number what?
Number 13, 1-3.
13.
Yes.
Huh?
It says there are.
Well, let's read the
choices.
question because the numbers differ for you. Read the question.
Oh, okay. Which of the following statements is GAAP, which is generally accepted accounting principles?
Let me see. Well, I don't know which of them.
There were two correct answers.
Yes.
Huh? Which of the following statement is incorrect? Is that the one? Huh?
No, number 13. 13.
Why am I having? I'm having something different.
Generally accepted accounting principles. So A says assets are equally listed in increasing order of liquidity. And IFRS assets are usually listed in decreasing order of liquidity. So this one is correct, and the other one also says current items are presented first on the GAAP, and on the IFRS, non-current items are presented first. Does it make sense, Professor?
Okay, which of the statement is incorrect concerning balance sheet prepared under IFRS and GAAP? Is that what you mean?
No. Which of the following statement is the generally accepted accounting principle? GAAP.
The question on GAAP.
I'm looking for, I'm concerning this thing. I'm looking at it. I don't know which one I have. Maybe I'll give you something different. Which of the following describe primary objective? Okay, so what was the problem there? Because I don't have it on my record.
Okay, so the problem is, I think, in my point of view, there are two correct answers. One is the GAAP, which is the generally accepted accounting principle. Assets are usually listed in increasing order of liquidity.
Yes.
And the IFRS assets are usually listed in a decreasing order of liquidity.
Yes.
So this one is correct. Yes, and the other one is under the GAAP, current items are presented first.
Yes.
Why cannot this be the right answer too? Because I think they have a similar meaning.
Well, for under GAAP, GAAP presents liquidity, depends on liquidity. 100% liquid. 100, you start with 100% liquid and you keep going. 100% liquid is cash, right? Cash
Yes.
is 100% liquid. And what is next to 100% liquid is investment. Is investment, short-term investment.
Okay.
And then
Okay.
after short-term investment, we have inventory. We have inventory. That's the next.
Okay.
Okay. Under that, then we can now, so many companies classify so many things under that. And maybe like other current assets. But the most important thing, that is how GAAP presents. But for international accounting standard, they put their own, the one that is least liquid. For example, inventory will come first, followed by investment, and followed by cash. That's what we should take note of. But are you saying there are two answers there?
Yes, the other one says on the GAAP, current items are presented first, which is correct because non-current items are come after current.
You say current
assets, right?
current items.
Assets. Oh, okay. So
No, that is not correct. That is not
okay.
correct.
The problem is with the items. Then okay, it should have said assets. Okay, makes sense.
Asset. Very good. Good. You got
it. Okay.
So that one is wrong. Okay. So that was good. Okay. I will continue to do my best, see what we can do to get this course under control. Next week, we'll be looking at the next chapter 6. And please read, you have the textbook now. So read chapter 6 because I want you to interact with me, discuss with me. If there is, when we are, as we discuss, we can discuss ahead. Like at times, I look at what we are going to cover in the next 10, 20 slides. I'm already talking about it now. So that if we discuss it, by the time we get to that slide, we just fly past it. We don't need to talk about it again. Or generally, I would have expected everybody to have that same picture. So cover chapter 6. I'm going to send assignment 2 for chapter 6 that you should be looking at based, and apart from the assignment you have, the ones we have discussed in class, those are the assignments for this week. For this week on this chapter 5. Also, when you are reading chapter 6, I'm going to provide assignment that will be due on Sunday. So I look at it. So that means we have done chapter 5, chapter 6 next week. After chapter 7 or 8, we'll do our second quiz number 2. That will be in 2-3 weeks' time. Okay? All right. Thank you very much for... yes, any other question?
Will you please post the presentation slides on Moodle?
Oh, okay. I will post that. The most important thing I want you to have your textbook, because at times, I deliberately, most of my classes, deliberately at times I don't post it because you have the textbook. I want you to read the textbook in depth, and then we discuss the presentation here. After presentation, I want to post the slide. I'll post all the slides up to chapter 5. So read chapter 6 textbook. I want you to have
Wellington, please mute.
I want you to have a broad view of chapter 6. Read chapter 6 very well. I want you to be having it in advance. Read chapter 6 very well. And then when I come in class, I'll bring the presentation. We look at it and discuss it together. And then we move. I can post that chapter 6 presentation thereafter. So that is how I do my own, I run my own class. The textbook is for you to read as students. Because if you look at the slides, you will know that we discuss far more than what is there on that slide. The slide is just a guide to us or to me to say, okay, these are the things we should look at. Look at the things. Then those things that is not even on the slide or textbook that I know is very, very important necessary for you to know, we have to discuss it in class. That is the way I go. And then after that, I will post that slides. You keep it for your record.
After the class. Okay.
Yes.
Okay.
All right. Thank you very much. And see you next week.
Bye. Have a nice day.
Bye.